Hello, in this lecture we're going to talk about installment sales and when they could be helpful to a business. At the end of this, we will be able to explain what an installment sale is, discuss when it could be applicable, and provide an example to illustrate the process of the installment sale. As always, you want to seek advice from a professional when looking into the installment sale. In order to go through this process, we're going to take an example, that example being we're going to have this property over here. This is going to be our property, no land, no building on it, whatnot. It's just going to be the property. We're going to sell that property for $100,000 in 4 equal installments. That means $25,000 each year. We're going to get the first installment as of the date of the sale of the property. I want to look at this in 2 ways. We want to see what it would look like in a normal transaction in terms of a book transaction, and then compare that to the taxes under an installment method. How would that change? And we can also take a look at what the recording could be when we're trying to track this information, that difference between the books and the tax. So let's take a look at this process. So first we're going to get $25,000 for year 1. So if we were to record this, we sold the land, we're going to get $25,000 at the time of the sale. So clearly the cash would then go up. We're going to have a debit. If you're not good at the debits and credits, that's okay. The story will make sense anyways. But we've got the debit here, increasing the cash. Then we've got the other debit to the notes receivable. So the $75,000 is what's going to be paid to us in 3 equal installments in the future. Notes receivable is going to go up by that $75,000. There's our 2 assets that are recorded for that. Those add up to $100,000. We're going to take the land off the books. It's on the books currently at $40,000. We can see here we're going to take it off the books at $40,000, a credit, reducing the land, of course, to 0. So the land is no longer on our books. And then the difference being the $100,000 minus the $40,000 means that we have a gain. We've got a gain on the sale. The sales price $100,000 minus the book value of the land that's on our books currently. That's going to be the $60,000. Now, this $60,000 is the issue. This $60,000 is revenue on a book basis, and generally that would be something we'd pay taxes for. Uncle Sam wants their share of the $60,000. Now, there is an argument to not have taxes on that. Our argument would be, hey, we didn't get the cash yet, and if it was a large sale, we might not even have the cash to pay the taxes on the full sale of the $60,000 in this case. And that's one argument for the justification of the installment process. So the IRS says, okay, we won't tax the entire thing. We'll try to tax it as you get the cash. So as you get the cash, we want to get some portion of the revenue at that point in time. So then the question is, okay, well, how would we do that? What's reasonable in terms of how much revenue we would record as we get the cash? That's going to be the installment process. We're going to go through this calculation. The calculation looks like this. We've got the sales, $100,000. That includes, of course, cash and the note. We've got the land, $40,000. That gives us the gross profit. So once we get all the revenue and whatnot, we've got gross profit, or on a book basis, we got the gross profit, $60,000. If we were to divide by that, the original sales price, $60,000 divided by the $100,000 original sales price, we would get a gross profit percent of 60%. So that basically means that for every dollar of sales price we have here, we're walking away with basically 60 cents on it. That's kind of what that means. So it would seem reasonable then, we can say, okay, how about we take the gross profit percent, 60%, times the amount of cash you receive. So whatever cash you received in year 1 happens to be $25,000. It'll be equal in this case throughout the process. Therefore, we're going to have $15,000 of cash, revenue that we then need to pay taxes on in year 1. That's going to be the idea. Now, we have an even allocation of cash being received. It doesn't have to be even, but as long as we have this gross profit percent, we're going to take the 60% times the cash we receive. In our example, how would that work out in table-wise? And then we'll look at it in terms of debits and credits. Table-wise, we'd say, okay, in year 1, we got $25,000 cash. We got $15,000 that we're going to record as revenue for taxes. Same in year 2, same in year 3, same in year 4. That means that, of course, over that 4-year period, we're going to get $100,000, the total cash, and we're recognizing revenue of $60,000 on a tax basis. But instead of doing that like we would under the book basis in year 1, we're doing it over this 4-year period. That's how it's going to work out. Because remember, the original calculation is sales price minus the book value, $60,000. We need to recognize this $60,000 Normally it would be recognized in year 1 under normal kind of bookkeeping. We're going to recognize it over that 4-year process because of this installment process and the cash being recognized and received over that time period. So you might be asking, well, how am I going to record this in terms of my worksheet here in order to see the difference between the books and the tax? What do the journal entries look like? And this is one way you can record it. You can remember that the book transaction in year 1, this is where we started off with. We got 25 cash. We've got on the books 75,000 receivable, and we've got this gain down here. This gain, we just said for taxes, needs to be 15,000 because we're only going to recognize 15 of it. Therefore, we got to reduce this gain for taxes. One way you can represent that on an Excel sheet on a table would be to reduce the gain by the 45,000. Why 45? That's what we need to get it down to the 15. And of course, this 60,000 represents income for the 4-year period in this case. So this 45,000 is 3 periods. It's the 15 times 3 to reduce it down to 15. And then the other side of it, you could record to just an adjusting account. We could just make an adjusting account. Why is that relevant? Well, if you're trying to compare this to like the tax return or something, trying to compare book value to the tax value, and you have a lot of these kind of adjustments, you can then work this problem and say, okay, here's my income for books, here it is for taxes, but it's only including these stuff up here. It's not including this adjustment. That's how it comes up to this 15 and how we can kind of still be in a reconciling process and track this in this format, in this way as we go. Year 2 then would look like this. For book accounting purposes, we've got the 75,000 over here. We're going to collect cash, obviously, on this in year 2 on this installment. We get the second installment, 25,000. Cash would then go up by the 25,000, like so. And then we would take it out of the note receivable. The note receivable now needs to go down. They owed us 75. They paid us 25. Therefore, they only owe us 50. So if we pull over all the other numbers, note that what is not affected, nothing on the income statement. No income in year 2 on a book basis. But of course on a tax basis, we're going to have to make this adjustment again. We're going to say, oh yeah, but on a tax basis, we have to recognize 15,000 because of the installment sale process. And again, the other side could be this adjustment account here to recognize that adjustment. So then again, for this year 2, we would see, okay, 0 for books, 15,000 for taxes because of this adjustment we made due to the installment process. That's going to be the same for year 3, so we won't go over the whole thing, but cash, we're going to get cash, bringing up cash. The note receivable for the books goes from 50 down by the 25 payment down to 25 owed to us after year 3. Nothing on income for the book side. On the tax side, we need to recognize this 15. We could put the other side to an adjustment account, therefore being able to say this is our books, this will tie out hopefully to the tax return. Year 4, and that of course is summing up all this, not this account. And then year 4, same thing. We're going to get cash 25, cash goes up. We're going to get the note here. So here's the note, bringing this down to 0. So nothing is due to us after year 4. It's all been paid off. On the tax side, we're going to have to recognize the gain. So here's the gain being recognized, and here's the adjustment account. So once again, in year 4, no revenue on the book side. We recognize that in year 1 on the book side. On the tax side, we've got the 15,000 here being recognized due to the installment sale process. So if we were to just sum this up one more time on the table, we have the tax in year 1, we've got the revenue or the cash received 25,000, revenue recognized 15,000, year 2 25,000 and 15, year 3, year 4, and if we sum that up, that's how we're getting the cash of 100,000, and we're recognizing this 60,000 over this time period, as opposed to the book process where we just have the sales price less the book value. There's the 60,000 on the book side. We recognize that when the property is given, when the transaction has taken place on the book side. On the tax side, we're still going to recognize the entire 60,000, but the code allows us, because of the cash allocation, to have this installment process. We'll recognize it over the 4 years.